You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we're going to be doing a review of the 2020 year for investing. We're going to answer a couple of listener questions, and then we've also got a book review on The Psychology of Money by Morgan Housel at the end. So, John, should we start with the 2020 years in review?
Yeah, so, thinking back myself, it was a hugely positive start to the year. We recently had an election in the UK after not having a majority government, and we'd had sort of an unclear position on what the UK's future was going to be, whether it was in the European Union, outside the European Union, or something in between. And late 2019, the majority government was elected and there was a clearer position. So there was some certainty that the markets could then have that we were actually going to be outside the European Union, and then it allowed for different stocks, depending on whether they were sort of domestic focused, whether dollar earners, they could settle at a price. So it gave some clarity, and also that we're going to have a strong government in the sense that whatever they wanted to pass was likely to pass on the basis of the new majority. So that had really been quite positive for some of the domestic UK focusing stocks. So your house builders and your banks like Lloyds and NatWest. So we were quite optimistic and bullish for the FTSE 100 and the 250 at that point as well. And then wasn't long before this sort of optimism really turned around. Sam, do you want to go on and discuss what happened after the highs of January?
Yeah, so we obviously COVID happened, didn't it? And we had, especially in the UK, we had national lockdowns, and that's really been going on since March. But in March particularly, I think sometime in mid-March, that was when everything bottomed, and it was really quite bad, wasn't it? Because I think the FTSE, it must have gone from about 7,000 and it dipped below 5,000 at one point.
In January, sort of starting this time last year, we were about 7,600, and then by mid-March we were down to about 5,100. So I think the 52. In fact, we dipped below the 5,000 at one point in March.
Yeah, and it was just a case of everything, it just seemed like everything was down, like 30% plus.
And you'd wake up and you'd see red. You'd see, and it was double digits for big FTSE 100 companies.
Yeah, it was very quick as well. It was within a few weeks it had gone from these highs to the lows, really, although it didn't seem like the lows at the time. And it was mirrored in the US as well at that point. So as the year's gone on, there's been a lot of like stay-at-home winners and stuff. So some of the US tech stocks have done really, really well. But even in March, a lot of these companies, they were down like 50% plus within a few weeks. And they didn't really, even Bitcoin was down about 50%. I think it dropped about 50% in a day at one point. And it didn't really seem like there were any safe haven assets. I think gold was, what was gold doing as well? Do you know?
I'd have to check that.
Because it started going back up. I don't know if that was in the summer. Let's have a look. How would I find the gold price? Goldprice.org?
Yeah, sounds about right.
Yeah, so even it looks like that dropped. It didn't drop maybe as much, but even gold was down probably like 15-20% in those few weeks before it then went on to set an all-time high in the summer. But it just seemed like there wasn't really any safe place, so there wasn't really much you could do about it, which maybe softened the blow. I
think to add as well with the FTSE 100 compared with the US index, it was that there weren't as many or anywhere near as many stay-at-home winners, and
they hadn't emerged in March. They were down as well.
They hadn't, but they didn't emerge after March either.
That's true.
So, and that's sort of summed up because the FTSE 100 is down 15% on the year, whereas the S&P 500 is up 15%. So from January 2020 to 21, S&P up 15%, FTSE down 15%.
obviously, since March, there has been a fairly steady increase for both the FTSE and the S&P, although the S&P, like you say, has done better and it's gone on to set new highs, whereas the FTSE is still below where it was in last January. How's your personal portfolio mirrored that?
So what I started doing when the market was falling, I was buying more heavily. So I had cash outside my ISA and within my ISA. What I did was I started buying much more aggressively. So I sort of sold some holdings, and primarily indexes actually, that I held within my ISA. I bought them back outside the ISA and then just really went in and was largely buying S&P 500, but also the world index. So on the year, I am definitely up. It's probably, depends which part of the portfolio, but I guess it would probably be up about 20+% on those sort of indexes where I went in quite heavily. Other parts of the portfolio, so I do hold Shell, and Shell's a company that was sort of hit partly because of COVID, but also before COVID. So they had, there's an oil glut at the moment. The oil price had been a bit depressed. It's been in the news a lot with Saudi and Russia disagreements that they've had, and led to an increased production. There'd then been the reduced demand globally with COVID, and that's really hammered BP and Shell, which are the two oil super majors listed on the FTSE 100. So they've been hit quite badly. Also, I've held UK banks, still holding them now, beginning to recover a bit, but they're well down on how they'd been prior to the start of 2020. And I've got a house builder, which is probably that's definitely down on where it was in early January 2020, because there'd been a lot of apparent certainty and the government's commitment to building more homes and more affordable homes, Help to Buy. So they've been quite badly hit, but overall probably up on the year, I would say. But that was largely because I was buying more aggressively than usual through that sort of March, April turbulence. It wasn't trying to time the market, but I hadn't perhaps in 2019 rather, the markets did seem more expensive. So I hadn't really been buying in as much as I might have done. So there was sort of the war chest ready to go. And in terms of individual stocks in 2020, I did buy Disney, and I did top up on Shell during what seemed to be a low point. I think that was when it was about £13, having previously been sort of in the mid-20s. That definitely wasn't the bottom. I think we went down to about £8. And was there anything else that I bought? I think they were the main stocks, and then it was just the indices, buying those more aggressively. What about you?
My portfolio's down pretty badly in March. I'm quite good at not checking it when it's down. So I couldn't actually tell you what the low point was. But I think my portfolio was based going into the year, it was probably about 50% weighted towards the UK and 50% US, with that 50% US being basically US tech, really. And then outside of that, I had a Bitcoin position that was probably about 10% of the portfolio, maybe. And then, going into March, I think probably at the low, my FTSE, my UK half of the portfolio was probably down about 20-25%, which all things considered wasn't too bad, really.
I'd say mine was probably similar. It was it had been down over 20% at points.
Because I had, whilst I did have one bank, a lot of the stuff that was probably hit the hardest, I didn't really have exposure to. So, for example, a lot of the businesses that I quite like, they're generally quite they're not very capital intensive anyway. So stuff like your oils and your energy, and even, like I said, I do have one bank, but it's a lot of it's more like money supermarkets and Hargreaves Lansdowns and those sorts of businesses. Sure. So they just weren't as badly affected, although they were still pulled down with everything else. And then in terms of the US half of the portfolio, I didn't check it that much when it was going down. I'd guess that must have been down, I'd say if it wasn't down 50%, I'd be surprised at the low.
Yeah.
And then in terms of adding stuff, I didn't really add a huge amount. So I've got my monthly amounts that go in to my ISAs, but usually it's rare that I'll go 2 or 3 months without seeing something that I want to buy. So I don't typically have that much cash lying around. So I really, March was probably a period of inactivity for me. I may have bought some stuff, but it would have just been with the normal amounts that I put in that month. I didn't have a big war chest like you did.
Okay.
But then the FTSE stuff, it's recovered a bit. So it's maybe my UK portfolios, it's maybe up maybe 5% compared to where it was a year ago. So it has recovered pretty much all the way. Well, it has recovered all the way now. But then the US side, I think I only held, it was quite a heavily concentrated portfolio. So I think I only held 4 US stocks going into the year. Yeah. And the 4 of them were Mercado Libre, Etsy, Pinterest, and Upwork.
Yeah.
And for the year, I think pretty much every one of them was probably at least around a 3x year over year.
Okay. Yeah.
So although they were down 50% in March, the year I've had has been it's been unbelievable, really. I'd be surprised if I ever have another year like it. My portfolio, and then as well, the Bitcoin has obviously done quite well as well. So in terms of my performance, I only work it out April to April, just because that's when the tax year is. But
sure.
I think I'm probably up around 100% for the year. Which I'd be amazed with. I wouldn't say my portfolio is excessively risky either. So given the stocks in it and the kind of stocks that I like, and that I'm not going for really risky stocks, I'm very aware I may never have another year like this again.
Well, in some ways, we hope that we don't have another year, at least caused by coronavirus that's like this.
I don't know. I'd probably take any cause I can get if I could.
You take it for 100%. Yeah. No, I can appreciate that.
It's interesting because I just obviously you've had quite a good year, but your behaviour in March was probably a lot more optimal than mine was, in that you did have this cash pile, whereas I've almost fluked my way into it, and I just happened to be holding stocks going into the year, which were the stay-at-home stocks. And obviously there's no way I could have anticipated a pandemic. I am well aware there's a huge amount of luck in there.
Yes, yeah. And I suppose I'd been, throughout 2019, I'd been more optimistic that we might have, a general election, we might have more certainty. And I was quite bullish on some of those domestic UK stocks, which after having a very turbulent 2019 was then appeared to have been rewarded in early 2020, only for it to be sort of shot back down again. So, I'd one of the house builders that I'd held for a number of years, but obviously also in 2019 had been Taylor Wimpey. And that's a stock that had been hovering, in January after we'd had the election, it'd been up to about £2.30 a share. But, during points in 2019, you'd be close to £1, and it's sort of been gyrating around a lot. And then you thought you'd had some certainty, only to find, I suppose life and the markets are unpredictable. So there's a lot of psychology in it as well, and whether you choose to hold your stocks. I mean, what do you think about the psychology? I mean, how are you feeling at points in March and April?
I thought it was all right, to be honest, but I know it does affect different people differently. I was fairly all right looking and knowing that everything was going to be down 5 or 10% again. And you just got desensitized to it, didn't you?
Well, I mean, we say 5 or 10%. The FTSE would be. FTSE, how far would
I'm talking about on the day though, not overall.
Oh, sorry, on the day.
You just look, you're like, I'm down another 5%.
Yeah, well, but then when you're down 30%, and how do you think it sort of? Do you think it changed how you were looking at your investments, whether you wanted to invest more or just hold or sell? Did you have any sort of those feelings?
I mean, I didn't really have any inclinations to sell, but what I would say, if I did have the cash pile available,
Yeah.
I don't think I'd have used it in March. I was very much of the belief, I didn't think we'd bottom in March. I thought, and when we did start to go back up, I thought, well, I mean, the economy's going to be in the tank. At some point, it's going to go back down and then some, because surely the stock prices have to reflect the underlying economy. And that proved to be incorrect. And fortunately, I didn't do anything with that, because I'm well aware that most macro predictions I make turn out to be wrong. So I just sat on my hands.
As do most of the professional economists' macro predictions.
Yeah. It's probably taught me the importance of sitting on your hands.
Yeah, I completely agree, because some of the stocks, have doubled or even tripled in the time since March. And if you were to sell or, be pessimistic about it and didn't see a way to recovery, and you just crystallized your loss, whereas actually if you'd done nothing, you may be down, or you may be even up on, on where you've been. I mean, I would clarify, while I was buying more aggressively in March and over the months from that, it was still sort of following that dollar cost or pound cost averaging. So buying the same indices, but I was just putting more money into the indices than I was doing a year earlier.
In April, when we'd started to go up a bit, did you think we'd bottomed? If someone had asked you, would you have said we'd bottomed?
Probably not.
No.
I wouldn't have been confident in making any predictions, but things were cheaper. And yes, given the news, they were cheaper for good reason. But sitting on the cash, I think it was also but how comfortable, given that the government were doing more quantitative easing and that the confidence of your cash holding value, that was a concern. And I think I wanted to allocate more cash to other assets. So that, in my case, was largely equities. I did start buying some commodities in the commodities index, Bloomberg Commodities Index, which we've talked about before. But that was really a fear for, inflation, really.
We're both dead wrong in March, basically.
Yeah, we're both dead wrong in March.
But that shows why it's so important, because you do get a lot of people that it's very easy, especially for newer investors, to actually look at the graphs in hindsight and say, oh, well, if I'd sold there and bought there, this would have happened. So like next time I'm going to sell when this happens. And when you're actually in the moment, it does not feel like you've bottomed. So trying to time it in any ways, it's usually, even if it goes right initially, you're probably going to come unstuck, and you're probably going to do worse in the long term than if you just sat on your hands.
Yeah. Or the recovery can happen very quickly. And if you're out of the market and you're on the sidelines, then you don't make the money, because you haven't been in the market.
And what do you do now? Would you buy back in at all-time highs, or do you hope we go down again? Because there's nothing to suggest we would go. So it's just a horrible position to be in, and it's probably worse than just taking the loss and just letting it ride out, I guess. Because I guess when you're holding equities, as long as you're holding decent equities, and I suppose it's certainly the case for you where you're holding indexes, you know that time is on your side.
Yes, exactly, and that's the thing. And I think you possibly become more attached to certain stocks, certain narratives, and the numbers to go with them, in the case of individual equities, than you do with an index. I think it's more comfortable, and you possibly have a sort of maybe a lower beta than you do with individual stocks. So it's psychologically easier to hold them for the long term than it is with certain stocks. And, with stocks, it's always when do you buy them, when do you sell them? And that's something that until you've bought and sold them yourself, you don't perhaps realize. I've certainly, stocks that I've sold, I've nearly always regretted selling them. It's rare that I've sold a stock and thought that was a good time to sell it, with the benefit of hindsight.
Yeah. And I think as well, if you're buying quality businesses, which I'd say you probably should be, it really only makes sense to sell, I think, in two conditions. One is that you need the cash. And the second is that if you've got a better idea, so you've got somewhere better for the money. And if one of those two conditions isn't met, I don't really see the benefit trying to be clever and selling a good business, because you might not get a chance to buy it back. And you may end up having to buy a worse business in the future because you've sold that good business that's gone on to do even better.
And then you may be willing it to go down so you can buy back in at the point that is, I mean, it's nonsense trying to do that.
Well, like, an interesting, I can't remember who says it, but if you decided to sell a business and try and time the market, you need to get two things right. And it's hard enough getting one thing right and just buying a quality business, but to then sell it and know exactly when to sell it and then buy it at exactly the right point that you're buying back in, it's very, very difficult to do, and you're probably not going to be able to do it.
No, and I think statistically, and historically, people aren't able to do that, not successfully, and not consistently either.
And I think if you are buying a quality business, if you're buying it for the long term, you are going to get volatility, and you need to be able to ride that out. And obviously, the longer you hold it, the smaller, if you look at a graph of Amazon over the last 20 years, there are parts on the graph where it's gone down, where it doesn't look that significant now, but it was very significant at the time. And it's easy to forget that when you're looking back. And I think if you just buy and hold, that's probably the way to go.
Oh yeah, without doubt. I think and you've got the cost of trading too, which aren't often factored into these things. But it's the time out of the market that costs you ultimately.
Yeah, and it's a lot less pleasant as well psychologically.
Yeah,
it is harder.
If you don't
want
stressful. If you don't want to see the volatility, then you probably shouldn't be in stocks.
Yeah, exactly.
But then you miss that. Yeah.
But I guess the best thing to do would be to just sort of set up an index, and then you're just buying in every month, and you can just forget about it. And you're buying when it's high and buying when it's low, and then hopefully you wouldn't be affected psychologically in the same way by the volatility.
Yeah. If you've got all your money, don't check it.
Exactly. Whereas that's obviously very different. So if you put all your money in one stock in one lump sum, you're going to be, the volatility is going to affect you a lot more psychologically than if you're just buying the same amount every month, and how it's worked out historically. So
yes, that's it.
What do you think of valuations in the UK and in the US going into 2021, and would those valuations affect your behavior in any way in the coming year?
Okay, so they're certainly more toppy in the US at the moment, but if the big tech companies continue to produce the earnings that they have been, they're probably justified. And I guess it depends how you feel about, your FANG stocks. In the UK is cheaper for good reason. Possibly a bit more bullish about the UK for 2021. We talked about the certainty that we thought we got in late 2019, early 2020. I kind of feel that we might have that to some degree again. We've now sort of left the European Union, and sort of a deal has been agreed, which the market is sort of digesting at the moment. Largely seems to be a positive one. So that you would hope would be good for some of the domestic focused UK stocks that have lacked that certainty. In terms of whether it changes what I'm doing, it doesn't really make any difference. I'm buying predominantly the world index and then the occasional quality company if I see it, continuing with the same strategy. Any stocks that I have sold in 2020, I'm reinvesting at the moment into the index. So for me, it makes no difference going 2021, looking to the rest of 2021. What about for you?
In the US, I think for the types of stocks I've been attracted to in the past, I'm finding valuations difficult to justify. Not to the point where I'd sell any of the businesses that I've got, but I've no intention to add in to any of my current holdings in the US at current prices. I think there are still attractive businesses in the market, but they're harder to find. But it's interesting because I think the shift has now been that a lot of the businesses that I find most attractive in the US are actually the much larger companies. I don't think some of these have had the same run up that some of the smaller ones have. So for example, Facebook, I know it's had a very good year, but I think we talked about it last week, and Disney as well. I think those valuations are still justified, and I'd be happy. I'm not saying I will, because it comes down to opportunity cost, but I probably would be happy to buy them and have them in the portfolio. Whereas compare that to some of the other sort of, for example, Mercado Libre, which I've got, that is extremely expensive right now. And I'm happy to hold it because it's a great business and it's doing well. And the business is performing very well, but I certainly won't be adding to it. So I think in terms of the US part of my portfolio, I'll probably either have a buildup of cash, or the money that is being invested will be going into different companies than I've been attracted to in the past. So it's probably more likely to be companies like Disney and Berkshire Hathaway and Facebook, whereas before it would have been much smaller companies with much more potential for capital growth. But I think so much, and I could be dead wrong, which is why I'm not selling what I've got. But I think these stocks have done so well in 2020, and I think in a lot of cases there's a lot of reasons to be optimistic about these stocks, but the performance of the stock is a lot better than the performance of the actual businesses themselves. And I think when that happens at some point, and it might not be this year, we could have another crazy year, but at some point the business does need to catch up, and that's either going to be through the stock dropping, or the stock might just be stagnant and returns have been pulled forward, and the business will catch up over a few years whilst the stock doesn't really go anywhere. And there's no way of knowing when that's going to happen, and it might not happen at all. But yeah, I probably won't be buying the types of businesses I've bought in the past this year, just because those businesses are now so expensive.
So what does that mean then? Does that mean that you'll be looking perhaps even more in the UK for some cheaper or cheap is probably the wrong word, undervalued quality UK businesses?
Possibly. So I do generally view my portfolio as almost like two separate portfolios, where I do like to keep that. I like to keep the US account and the UK account separate. So if the money's going into the US account that I'd have going into it, I'd be reluctant to put it into UK businesses. I don't know whether that makes much sense, like, logically, but I don't know, it's just, I quite like having them all in one place. But I do find the UK more attractive than the US at the minute. I don't think I'm really short of UK businesses that I'd like to own. And I have been in recent months, and I'm very happy to continue topping up businesses I currently hold, whereas I'm not topping up any of my US holdings. But the UK companies, I think there's a lot of UK companies that are very attractive at the minute. And especially, I mean, if you compare them to the US companies, I mean, there's some really quality companies at quite reasonable valuations. I think we did talk about a few of those companies on last week's episode, but I probably am more optimistic for UK. I'd be, if things stay as they are, which they very rarely do, I'm probably not going to struggle to put money to work in the UK part of my portfolio. But yeah, like I said, for the US, the money going in is basically split in half, really. So for the US part, I'd be reluctant to start buying UK businesses because I like to keep that 50-50 split on a cost basis, but it's not something I'd rule out, but it's probably unlikely.
Yeah.
I think it's quite interesting as well, because I know you don't use Twitter at all.
Yeah.
But you've got 29 followers now, actually. Okay. You've got quite a few from the podcast. Yeah, but there are some really, really good accounts on Twitter, but quite a few of those accounts, a lot of them are US, and they post every month. They post what they're holding, and they post their portfolios and their performance, just so they have that accountability, really, and you can see that. You can see whether or not they're doing very well. So I suppose if they're doing well, it's a plus for them in attracting followers and people taking what they say seriously. But one thing that I've found quite interesting, and it's only something I've really noticed in the last few months, is that when they're posting their list of holdings at the month end, I think there's now a few companies starting to creep into those lists that are suspect. I don't know. It's just, there's a couple of companies where, so for example, there's a company in the US called Magnite, and I'm not going to go into it, but it could be a very good company, but there's a few red flags, and it's enough that I would just avoid it completely. And I think most people a lot of the people that I follow on Twitter a year or two ago would have felt exactly the same. And I think what's happened is when they're having to put money to work now, especially if they're in the US, I don't think they really consider investing in the UK at all because they don't know the companies. And it's I guess if you are in the US, why would you think about investing outside of the US? Because your own market has so many quality businesses. But I've noticed a few of those companies that are a bit more, what's happened is everything's run up, and these companies such as Magnite, where there are a few red flags, they're still looking quite cheap. So they've now found their way into the portfolios. And I think that the run up in valuations for a lot of the US tech stocks means that for a lot of the growth investors I follow on Twitter, if they want to try and maintain the returns they've been getting, I think they've had to start looking at companies that are lower quality. And that doesn't necessarily mean that those companies won't do well and they might feel the risks are justified. But I just think a year or two ago, there were some very, very good companies trading at valuations that in hindsight were very, very cheap. And now to try and get those sorts of returns or find those high growth companies, you maybe would have to accept a couple of things that you wouldn't have had to compromise on a year or two ago.
Sure. All right. So we've got some listener questions in from last week. What's the first, Sam?
All right. So the first one is Eric, and he said, "Thanks, guys, for your podcast and UK focus. Looking forward to 2021. I'd be keen to hear more about how you guys find UK companies, how you value them, what numbers are important or not, when to pull the trigger and when to wait, strategies and allocation, trends." Do you want to go first?
Well, I think if you lead on this one, Sam. So do you want to talk about it from the accounting metrics with your accounting background?
Yeah, so I'll just go through it bit by bit. But in terms of like how I actually find them, if you've not already got a watch list, I think a good thing to do would probably be to subscribe to the Motley Fool UK stock advisor service. I think it's about £150 for the year. We don't have any affiliation, by the way, but I think it's about £150 for the year. If you sign up on their website and give them your email, they'll start sending you marketing. And if you wait long enough, they'll send you one where it's 50% off, or you get 2 years for the price of one. So it's a bit like buying a Domino's. You should never pay full price because eventually they will do like a 40 or 50% off day and you should just get it then. But I'd say if you do that, their reports are very good. And I think they will probably put a lot of very good companies on your radar. And what I quite like about doing that as well, if you're building up your watch list, is that they post their performance compared to the market for all their picks. And historically, their picks do beat the market. So you know that straight away, your watch list, you're picking from a pool of companies that statistically they are likely to beat the market already. And then you can just cherry pick the ones that you're interested in. In terms of other ones, I generally only look at FTSE 350 companies. It's rare, unless it's a bigger one like Boohoo or ASOS, it's very rare that I would actually look at an AIM listed stock just because I'm not as familiar with them. I prefer businesses I actually know.
On that point as well, it's always good, I think, if you're investing to keep up to date with the news. So whatever newspaper you read, you might look at some of the bigger, broadsheets or sort of better known newspapers and read their city section, read their business section, and it'll give you an idea what's sort of going on in the market. And maybe you'll come across some companies that you've either heard of, you haven't heard of. You'll get updates with their earnings and things, and you may develop an interest in a business, which you can then sort of research and go into the numbers further.
Do you want to talk about because you actually, I don't read the newspaper, but you are actually subscribed to one. So do you want to talk about that?
So I read the Times, and I've read the Times for a long time, and just the business section, they do have some, a stock picking, their stock picks. I'm not really too influenced by their stock picks. It is interesting reading what their analysis of each stock pick that they do is and why they think it's a good business. But I think just seeing the different UK company names, what they do, because when I started investing, I hadn't heard of half of the FTSE 100 companies. I had no idea what they did, but I was probably using their products and services just unknowingly. Unilever is the classic example where you find that billions of people in the world use a Unilever product every day, but they never look at the back. It's a brand to them. So whether that's, Dove soap, Marmite, Magnums, it could be any number of things. They're all sort of coming or owned by one company that you may well have never heard of. And then once you sort of that company, you develop an interest in it, you can look into the numbers and see whether on the metrics and the valuation, it's something that would, warrant further investigation. I mean, Sam, do you want to go a bit into the numbers and sort of metrics that you do look at?
I'd say as well, in terms of following companies, if you sign it, if you create an account on the London Stock Exchange website, you can go through the full 350 list and it will let you create a watch list. So any company that sounds interesting on that 350 list, you can just add to your watch list, and then you can set it so it emails you updates, and you can choose what kind of updates you get. So mine's just set so if there's quarterly, half year, or full year earnings, I get an email telling me, so I can then go and look at those, and it's much easier then to follow them, just because you're being told when there's something that you need to look at. In terms of what I actually look for, it does completely depend on the business, really. There's no one size fits all. If it's a smaller company, I'd typically look at the revenue growth. If it's a larger company, I'd look at the price to earnings more. So for example, like you mentioned Unilever, for me, the two most important metrics for Unilever would be the price to earnings multiple compared to historical levels, and the dividend yield, because that's what you're buying it for. If on the other hand, you're buying something like a Boohoo, which we looked at a couple of months ago, but that Boohoo's very, very expensive. And the thing I'd be looking at is the revenue growth. And then if the revenue growth is good, there'd be other things I'd look at as well, which would be, for example, like how much of that revenue is actually flowing through to profit, and what you'd expect to flow through in the future. When I'm looking at like US tech companies, one thing I'll look at is like what are the sales expenses, what are the marketing expenses, what's the R&D, because these are things where typically the company might make a loss, but they're deliberately putting all the money back into those things. So if you take those out, you find that it's actually very, very profitable business. The gross margin, depending on the type of company it is. So if it's like a software company, I'd really want something with like 70 or 80% gross margins, so that when it has finished growing, there's a good chance of it flowing through into high profits later on. But in terms of the numbers, it's those sorts of things, but it does really depend on the company. So for example, with a bank, probably be more likely to look at the book value. That's a metric that's more commonly used. But then the book value is not something you'd use for most businesses that you look at, because there's so much besides that. So for an example would be something like Disney. Using the book value for Disney would just not make any sense, because they've just got all these intangible assets. And equally with Disney, like such a key metric at the minute is that growth in the number of subscribers for Disney Plus, and that doesn't show up anywhere in the accounts, or it won't show up anywhere on the figures, but that is such a key metric that you'd need to use. So it's unfortunate there's no answer really, because it depends entirely on the type of business that you're looking at, and every business is different. So what I look at for one business is going to be completely different to what I'm looking at for another business. And if you're looking at the same types of businesses, you're probably going to be looking at the same types of things, so you can start to build up more of an idea of what you want. But yeah, in terms of the numbers, I don't think there's anything specific for all businesses really. I mean, with Unilever, if they grew at 5% a year, I think that would be very, very good. If a US tech company was growing at 5% a year, you probably wouldn't want to buy it if it's trading at 20 times sales, whereas Unilever, it's only sort of 30 times earnings, so it's completely different. And then market cap as well, that's obviously quite key. So that's the actual size of the business, because it might be that a company's growing a huge amount and it's performing very, very well, but you then need to look at how much of the growth is actually already priced in, because if you don't think that in the future they can get to a level to have the level of profits that justify the current valuation, it doesn't really matter how much it's growing, because, well, if you just don't think it's ever going to be profitable enough. So that's the issue that I think we've both had when we've looked at Ocado. The business is performing well and it's growing at, I think, about 40% a year, which is very impressive. But then it's a very low margin business. It's very capital intensive because they've got to reinvest in all these robots. And that's just something where I look at it and say, even if the growth does tick all my boxes, I don't think it's ever going to be profitable enough that it's going to make enough of money to justify the returns, especially at the current valuations, which are very, very pricey. Do you have anything to add on that, John?
No, I think those points that you make are the things that you'd be looking at in terms of explaining it. I would say Benjamin Graham's The Intelligent Investor is probably a good place to start. Some of it may not be as applicable to certain companies today, but it's certainly a good place to start in explaining how you'd look at companies and the valuations and how you might go about valuing them practically in little checklists. Would you have any recommendations on that front?
I think in terms of the numbers, there's a series called the Buffettology series, and the whole series is quite good, especially for beginners. But there's one book in there called Warren Buffett and the Interpretation of Financial Statements, and it's been written by Warren Buffett's former stepdaughter and some guy who used to work with, or we used to work for Warren. And I don't think they really knew him that well, but they've looked at his track record and his history, and they've tried to identify the things that he generally looks for in companies. And they basically go through a set of accounts, how they think Warren Buffett would go through them, and they explain in very simple terms what he likes and what he doesn't like. So an example would be he typically would go for companies that don't have much debt, and that's something where it's quite easy to understand and apply. So it's quite an easy book for just familiarizing yourself with financial statements. I think you could probably, it's a very easy book to read. You could probably read it in like a couple of hours. So that's probably the book I'd recommend for getting to grips with the numbers. In terms of what he said about when to pull the trigger and when to wait, and then also his comments on allocation.
So pulling the trigger, I suppose, if you've made the decision on the company and you think that the valuation is fair, I think there's now is the answer. You'd want to do it as soon as you can. I don't see any reason why you would hold off buying a company. And then the advantage is you can hold that company for a longer period of time if you buy it now as well.
Yeah, I think historically that's, if you're identifying good companies, it's usually you're better to buy it straight away. The only thing I'd say is sometimes you might find a company where it ticks every box except valuation. And I don't know, some of those companies, expensive companies can just stay expensive forever. So like sometimes it might be worth just putting a smaller allocation in it, even though it's a very, very high price. And then what that means is if it continues to do very well and stays expensive, you don't feel like you've missed out and you can still do very well from it. But if it comes back down or it does quite poor, or if the valuation adjusts to what you consider a more reasonable level, you can then add to it. So you're covered on both bases then. And then in terms of allocation, I think it's really just what works for you. If you are identifying very, very good companies, the more concentrated your portfolio, so the fewer the number of stocks in it, the better you'll do. But that does work both ways. So if you have a company that doesn't do as well, and that could be through no fault of your analysis, you could do it completely spot on and something could hit the company that no one could have anticipated, you're going to be hit by that quite hard. I find the best way to do it is my individual portfolio is probably quite concentrated, but I also have a proportion that just goes into a index funds, which is just my pension goes into that. So that's how I justify having the concentrated portfolio, because I know that my pension's going into index funds and I'm pretty confident about how they'll do in the long term. So I don't need to worry about the concentration risk. And also, like, psychologically, I know that I am able to handle when the stocks are down big. And if you don't think you can handle that, then you're probably better having a more diversified portfolio, even if you think it's going to hurt your returns over the long term.
Yeah. And by holding it for a longer period, and if you want to, there's the strategy of dollar cost or pound cost averaging, whether that's with an individual stock or with an index. If you're just buying the same thing at the same time every month, putting a smaller amount in rather than one big amount initially, it can reduce the volatility. I think it's particularly applicable with indexes, possibly less so with individual stocks. But that's something that can help. So you could, Sam, you sort of mentioned it earlier, just buying a smaller amount and topping it up later. But, there's lots of automated systems, or you could just even set a reminder on your calendar or whatever app you have just every month to buy more of whatever stock it is or the index. Disadvantage of that is that you may, miss out on some growth if you don't put it all in one go. And also that if it's an individual stock, depending on what trading platform you're using, you could be increasing your trading fees. So that's something to consider. But if you're, Vanguard, and obviously we're not affiliated with Vanguard, You can buy a lot of their ETFs, so indexes, and they don't have fee if you're buying their own products. So there are ways of minimizing the expenses if you were to pound cost average.
I think there's something to be said as well. It's less of a problem when you've got a smaller portfolio, because you're always your allocation, you're going to get diversification later on because you've got so much money to be added. But as your portfolio gets larger, there's a lot. I think there's a lot to be said about trying to find assets that you would expect to do well that aren't correlated to each other. And if you're interested in learning more about that, I think there's the book that we've talked about a few times, the Ivy Portfolio. There's an American guy called Ray Dalio, and he's done a lot of stuff on that, and he's written a lot of stuff on it, and he's really, really smart. But yeah, so an example would be that if you're entirely in equities of one country, so say you're all in UK equities, they're generally going to move together. And over the long term, you'd expect the better companies to do better, but in the shorter term, they are going to rise and fall together a lot of the time. So if you added, for example, US equities as well, you then, even though you're still in the category of equities, you're diversifying and you are reducing the volatility, because sometimes the UK equities can go up and US equities go down. And then if you can add other parts of the world, which is where I think indexing into different parts of the world is so useful, you then decreasing it even more. And then if you've got the wealth to do it, it's obviously like you can invest in real estate, and then there's other types of assets. So an example would be Bitcoin. I think that is something there's a very low correlation to stocks and bonds. I know they all dropped together in March, but I think that's unusual. I think typically Bitcoin seems to just do its own thing, really. And then you've got commodities as well, which is like John said, with the commodities index. And I think that's something that's more of an issue as your portfolio gets larger. Because if you only have the money to buy one stock, you know it's going to be volatile, but you're obviously going to increase that naturally. When you add your second stock, you're going to decrease that volatility. So I think especially as your portfolio gets larger, adding uncorrelated assets is something that you should definitely try and do.
The other thing to say would be that the allocation of your portfolio probably varies depending on your age and what stage of life you're in. Yeah. So if you're coming close to retirement, it probably wouldn't be advisable to have most of your wealth tied up in equities if you need that wealth or access to that cash, because you're probably at a stage where you can't take as much volatility and you may not be able to ride the market out for longer. So as you get older, you may reduce your allocation towards equities. But probably when you're younger, you'd want most of your assets to be in equities so you can enjoy that growth for your lifetime, or for as much of your lifetime as you can, before tapering down to less volatile assets or asset classes.
Because if the average economic cycle says 5 to 10 years, if you're 25, there is whatever happens in the near term, you'll be able to ride it out. If you're 65 and you need to sell them tomorrow, then you're obviously praying that stocks don't drop today. But the more time you're going to be able to be invested in the market, the better it is, really.
And it's probably important not to overinvest or buy on the margin, because you want to be able to leave it in for the long term. You don't want to be a forced seller, which if you're overstretching yourself, you could be.
Yeah, I mean, I don't know very much at all about options trading and trading on margin and stuff like that, but that's because the little I have read about it has been enough that I've just decided it's just something I'm never going to touch.
Yeah, quite.
For our second question, it was, what do you think of the huge rise in Bitcoin and the largest ETF funds buying into it, as well as many billionaires putting huge sums into this, such as, I think, Cathie Wood. And I think there's also a point about it being open 24/7, 52 weeks a year. I would say that we actually covered this in some depth in episode 14. And if you just listen to that from 21 minutes, we basically give all our thoughts on Bitcoin. And for anyone that's already listened to that, we won't go over them again because they're probably getting sick of it by now. Right, so shall we finish off with our book review?
Yeah, so what's the book this week?
So the book is The Psychology of Money, and that's by Morgan Housel. Morgan Housel, for anyone who doesn't know who he is, I think he's a partner at the Collaborative Fund. Previously, he was a columnist. He was a columnist at the Wall Street Journal and Motley Fool, and he's basically now just a writer, really. And he's actually he's got most of his money invested in index funds rather than picking individual stocks. He's quite active on Twitter, so I'd say he's definitely worth following. And this is a book that's certainly on like financial Twitter. If you follow a lot of investing accounts, it's a book that's done the rounds, or it came out last year and a lot of people have been talking about it. So I thought it did live up to the hype, actually. I thought it was quite good. So the book's split into 20 chapters, and each chapter, it's only, I don't think there's any chapters longer than about 15 pages, but each chapter goes over a psychological lesson. So here's just a few of the lessons. There's a lesson about avoiding the extreme ends of financial decisions. You should like risk because it pays off over time. Defining the game that you're playing so that you're not comparing yourself to people who are trying to achieve something completely different to you. It talks about managing your money in a way that helps you sleep at night, increasing your time. So it's just loads of like really key lessons for investing, really. And each one, it's psychological lessons as well, and just how your brain's wired in terms of investing. And for each chapter, it covers a different topic, and it'll just give like stories and talk about like these psychological lessons and then link it back to investing. What I liked about the book actually is that I think whether you're just starting or you're very advanced, you could probably read it and you'd get a lot from it. I think it's easy to understand, but there's enough in there that someone who's reading it, who's already read a bit about like psychology and behavioral investing and stuff like that, they'd also pick up stuff from it. I thought it was a very, very good book, actually. I've read quite a bit about psychology, but I've probably not read a book like this where it's just every single point in it is tied back to investing. I've just read actual psychology or like behavioral economics and stuff like that. So it is quite to just have it all in one book. So yeah, I'd recommend it.
Excellent. Well, I think that's it for this week, and we look forward to seeing you next time.
Yeah, we should be back to a normal episode format next week because we should have some actual news to talk about.
All right.
See you next
See
week.
you then.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.